Hello and welcome to People Making Money. I'm your host, Kevin Bemmel, and we are here every Wednesday at 10 a.m. Pacific time to talk about matters related to business and career development, whether it's starting a business or moving yours to the next level, and also wealth building, how we build the kind of financial legacy that we want to have that aligns with our goals. So for some people, I presume that means they want a 10-figure net worth. For other people, something significantly more modest is just fine. So however you define financial success, we are here each week to give you some ideas, some thoughts to ponder as to how to reach those goals. So today I'm going to talk about it is my favorite book on investing in securities. I've got it right here. It's called A Random Walk Down Wall Street, and it's written by a fellow named Burton G. Malkiel. This particular edition is the second college edition. I didn't realize that, but it was published in 1981. So this book was originally published in 1973, so 50 years ago. It has been updated several times since then. But the essence of the book, I think, remains consistent throughout the decades. This was actually given to me by my girlfriend at the time, 1981. I was still in college myself, and didn't know a whole lot about investing and such. And I was really captivated by Malkiel's ideas. So we're gonna talk about those ideas. But before we get to that, I want to talk about the main hypotheses that exist with respect to investing in securities, primarily stocks, although they they can apply to bonds as well, and other derivative type investments. But generally speaking, when we're talking about investing in the stock market, so there are six main hypotheses for investing in the stock market. I'm just going to name them quickly, and then I'll go back through and give you a little bit more information on each one. So there's the efficient market hypothesis, the random walk theory, which are kind of related. Then there's the fundamental analysis theory. There's the technical analysis theory or hypothesis, the behavioral finance, and finally the market microstructure theory. So each one of these is a way of thinking about how the stock market and in some ways people in general behave, and therefore how one can be successful in investing in stocks. So let's start out with the efficient market hypothesis. So when we talk about the efficiency of the market, what we mean is how quickly does the market absorb and process and reflect new information. Okay, so a market like real estate, generally speaking, is not particularly efficient. And the reason is because if let's say I own an apartment building and I rent out a unit in my apartment building, and that the rent I get for that unit represents a new high or low in the marketplace. Well, first of all, that's a private transaction. So most other, in fact, maybe none of the other participants in the market will have that information. So until that information, first of all, gets known, the market won't reflect that aspect. And so this is one of the reasons why, especially for large buildings, owners and management companies do periodic rent surveys. So, just to give you an example, in one of the properties that I'm responsible for, we have a vacancy, and I did a rent survey yesterday to get a feeling for where our rents at for this particular type of building in the location in which it is situated, so that the asking rent that we are advertising can be as accurate as possible. Having said that, um, my rent survey was really based on other vacancies asking rents, so it doesn't necessarily reflect the actual rents that those buildings are achieving, because that information, generally speaking, is not available to the general public. So I could call up owners of buildings and ask them, but having done that in a previous life, most owners will decline to answer, some somewhat annoyedly. But so, generally speaking, rent surveys are done on an asking rent basis, which of course, even though we may have the most up to date asking rents, that doesn't mean we have up to date actual rents, because again, those are private agreements between a tenant and a landlord. So, and that's just one reason, by the way, that real estate markets are considered to be relatively inefficient. So, securities markets are viewed to have, depending on whose view you're talking to, may have a greater or lesser degree of efficiency, although in general greater than real estate. So, the efficient market hypothesis (EMH) is based on the idea that new information spreads through participants in the marketplace very quickly, so that the stock markets essentially immediately reflect that new information. So for example, let's say that the Federal Reserve changes its benchmark interest rate. So there will be an announcement, and the idea is pretty quickly anybody who's participating in the stock market will know that information because it's been made public. It's probably been broadly publicized by newspapers, television, and other news organizations, etc. And so, very quickly, people find out about it. And in fact, if you think about it, even if you are not actively following economic trends, if the Federal Reserve, for example, were to change its benchmark interest rate, or its target rate, I should call it, you're probably going to hear about it pretty quickly, because number one, it doesn't happen that often, and number two, it is of particular note in terms of how it affects the economy, or how it may affect the economy. So even if you are not, an investor in the stock market, you're probably going to hear that the Fed, as it's called, has changed its target interest rate. So again, the idea behind the efficient market hypothesis is information is quickly fully reflected in prices and activity within the stock market. Okay, and there are different versions of it. I'm not going to go into that today. That's kind of beyond the scope of what we're doing. But in any event, um, uh, there are different, like I said, different versions of it. Okay, so the random walk theory, which of course is the theory that was posited by Burton Malkiel, is the idea that stock prices move randomly, and therefore you can't predict the direction of stock prices. And the basis for this theory is the idea that, let's take a situation where a company has just announced that its quarterly earnings are have gone up, and indeed are at an all-time high. So one would think, if you have an investment where the earnings underlying that investment have gone up and are at a record level, you would see the value of that investment go up. But indeed, if you were to follow, the stock market, you would see that sometimes a company will announce higher earnings, and yet nonetheless, the price of the stock will drop. So, what is that about? Well, it could be due to a number of factors. One is that it could be that investors were anticipating that the company was going to announce record earnings, and so they've already priced into the stock before the earnings announcement that um, that 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 factor of higher earnings, and so when the actual announcement is made, perhaps what was anticipated in terms of what earnings would be actually turned out to be lower than what people anticipated, and so they're like, "Oh no, I thought earnings were going to be, $3 a share, which was an all-time high, and indeed they were only $2.75 a share, which still was an all-time high, but was lower than what I anticipated, and therefore." The price of the stock drops. And so, um, and you can see it in other areas. I'm just giving you one example of where prices seem to move at random. And, you know, another would be, let's say that, well, so it's probably no surprise that the United States is making a lot of weapons procurement contracts currently to replace stocks of things like howitzer shells that have been depleted, missiles and rockets that have been depleted. Through giving them to Ukraine, Israel, etc. And so one would think that defense company stocks would be seeing, big increases, and yet that's not necessarily the case. And again, some of this has to do with how people anticipate what prices will do. But again, just because a company is experiencing record orders, or not even record orders, but just a large increase in orders, there are other factors that undergird what a stock's price may be. So at the same time that there's a lot of orders being placed for weapons, the federal government is running huge deficits, around $2 trillion a year, record deficits. And so investors could be concerned that, well, okay, they're placing all these big orders, but where is the money going to come from to pay for them? And in the next budget to come out of Congress, are they actually going to budget for these, or are they going to end up canceling these contracts? Okay, because government contracts generally come with a provision that they can be canceled if the appropriations necessary to pay for those contracts are not made by Congress. So you can see just in a couple of there's just a couple of factors that influence a stock's price, and again, depending on how different market participants are viewing those factors and either pricing them in currently or anticipating how they're going to be priced in, or maybe waiting to see how they fall out, the price of a stock might move differently than one would think it would, based on whatever particular announcement is made in the media. So that's the idea that undergirds the random walk theory. Okay, next is fundamental analysis. And fundamental analysis approaches investing by analyzing the financial health of and performance of a company, including its earnings, its revenue, its assets, and its liabilities. So basically, the financial statements of a company are closely examined, and you get a sense of what's called the fundamentals of a company, hence the name fundamental analysis. Okay, and what an investor is trying to do is get a sense of the intrinsic value of a company. So I'll give you an example. Take a real estate investment trust, which is essentially a company that is organized to own real estate. Okay, so it is sometimes the case that if you were to add up the value of all the outstanding shares in that REIT, that's short for real estate investment trust, you would find that that value is higher or lower than the current appraised value of the real estate that it owns. Okay, so let's say that there's a REIT out there, and the current value of the real estate it owns is $5 billion. Okay, and let's say it has a $500 million of liabilities, loans against the real estate, and so the net asset value of that REIT is $4.5 billion. And then you go and add up the value of all the shares of that REIT, and you find out that the shares of the REIT are currently valued at only $4 billion, right? So it would appear that there's a value gap of $500 million, right? And when that's recognized, a couple of things might happen. One is that people will bid up the price of the shares in order to equalize that difference. Another is that someone may make a bid to buy all the outstanding shares of that REIT at the current share value, knowing that if they were to pay $4 billion for all those shares, they could turn around and sell all the real estate for $4.5 billion and make a $500 million profit. Now, these are somewhat simplified examples. And so, obviously things in the real market are more complex, but that gives you an idea of how fundamentals work. That's probably the easiest way to see it. And so it's really looking again at the intrinsic value of a company and making an investment decision based on those factors. Now, that is oftentimes contrasted with what's called technical analysis. So technical analysis uses historic price data and trading volumes to forecast future price changes. Okay, so if you were to look at, for example, the Dow Jones Industrial Average, okay, it moves up and down over time, although historically it has moved up, okay, but there have been times when it's gone down and other times when it's gone up. Sometimes it's gone up slowly, sometimes it's dropped quickly. Okay, so the Dow Jones Industrial Average is an indication of the movement, the fluctuation of prices in the overall marketplace. Okay, and based on where the Dow Jones Industrial Average is at, that for technical analysts gives them clues as to where the future direction of the market, i.e., will it go up, will it go down, will it stay relatively flat? Okay, and they'll look at that. They'll look at trading volumes, hundreds of millions of shares or billions of shares traded, or is the trading volume low by historic standards? Is it very high by historic standards? And what does that mean in terms of what may happen in the future? So technical analysis is looking at market trends. So the way a particular company performs is not of interest to technical analysts, just like the way the overall market is performing is really not of a concern to fundamental analysts. That's why they're sometimes considered to be kind of in opposing philosophies. Okay, so again, that gives you just briefly what those are about. Okay, next one is behavioral finance. So this is really seeking to combine psychology and economics to explain why investors make what amount to irrational decisions. So going back to that example I gave about the random walk theory, where A company announces record earnings, and yet the stock goes down. That seems to be irrational. So, why are people selling a stock at a time when a company is announcing record earnings? So, that's something that behavioral finance would seek to figure out, okay? Because it appears to be and may be irrational, especially if the record earnings that the company announces are followed by an announcement that it looks like earnings for the succeeding quarter are going to be even higher. It's like, well, why would the price of the stock drop, which would tend to indicate that people are getting out of the stock? So there may be a psychology there. It may be that more broadly, people are souring on the stock market because they feel like a recession is in the offing, and so maybe they don't believe that the company's future earnings are going to continue to increase. And because they're anticipating a downturn in the economy, even though, by the way, all the economic indicators may be strong, and there's nothing really to say that we're heading to recession, but sometimes people get into a kind of a negative sense about the economy, and if people are feeling, as we used to say, blue as opposed to depressed, blue about the economy, so they will act in accordance with those feelings or those thoughts about the economy, even though all of the current indicators would seem to be the opposite of how people are feeling. So the behavioral finance model is looking to understand and to a certain extent reconcile those kind of things and predict the market, based on those factors. Okay, and then finally, the market microstructure theory. When I was doing some research for this is the first time I've come across this. So it really looks at the processes and outcomes of exchanging assets under explicit trading rules. So it'll look at things like transaction costs, types of orders, how market participants behave, behavior affects the prices of stocks, and the liquidity of stocks. So it's kind of like, I think, sort of technical analysis and behavioral finance put together into one theory, and so you might call it a bit of a hybrid. So um, you know of these, the ones that you will hear the most about are the efficient market hypothesis, fundamental analysis, technical analysis. And then those are the three most that you'll hear about most commonly. And then after that, you'll hear about the random walk theory and behavioral finance. So that gives you an idea of the different kinds of philosophies, if you will, or theories of how the market works out there. And I wanted to go through that because that forms the basis of Malkiel's work in a random walk down Wall Street. So in his book, um, he makes the case for the random market, a random walk theory, i.e., that stock prices are unpredictable. And I think he even uses the concept that the markets move similar to the way a drunk person kind of you're never quite sure which direction they're going in, and so because of that, it's Malkiel concludes that it is impossible to consistently outperform the market through stock picking or market timing. Now, I'll define those terms. Stock picking means, just like it sounds, picking individual stocks. So let's say today, you're investing in, and these, by the way, these are not these are not recommendations at all. I'm just giving an example. In fact, I won't even give real names. Let's say you're invested in stock A today, and you're examining the market, either the market fundamentals or you do a technical analysis on company A, and you decide that it's time to get out of company A, and based on your analysis, it's time to get into company B. Okay, because company A, maybe its price is going to drop and the price of company B is going to go up. Okay, that's stock picking. Okay, and Malkiel would asserts that you can't do that consistently over time. That inevitably you're going to make mistakes. And the fact of the matter is that even for highly skilled, highly successful investors who do so-called stock picking, the reality is they make mistakes. Okay, so nobody has 100% batting record when it comes to stock picking. Nor now market timing is the idea that, well, now is a good time to get in the market, or now is a good time to get out of the market. So you're trying to time the market in terms of, is it at its peak? If it's at its peak, you should sell all your investments and put them in cash, because the market's going to drop. Okay, and then when it gets to its trough at the bottom of the market, now buy in again, right, and now ride the market back up. So the idea is, sell high, buy low is the ideal market timing idea. I'm sorry, sell high, buy low. I hope that's what I said, right? Because that would maximize your return. And again, Malkiel is saying, because of the randomness of the market, you can't do that timing successfully. Now, I was talking to a friend of mine who's a data scientist a couple nights ago, and he was telling me that he has an idea for developing basically an AI that would write the algorithm that would allow someone to predictably either time the market or pick stocks. I'm not sure which he was talking about. Now, and my response was, well, if you're able to do that, okay, then while you may be able to beat the market initially, pretty quickly people will copy what you're doing. And if everybody's copying what you're doing, that will essentially erase the advantage that you have, right? Because the idea of being able to time the market correctly is you're making the correct decisions while other people are making incorrect decisions, right? That's in the end, people talk about investing in stocks as a kind of a form of gambling, or there's a joke about, well, we won't call it gambling, let's just call it betting, right? But indeed, when I place a buy order for a stock, right, in order for it to be filled, somebody has to have placed a sell order for that stock. So one of us is betting that it's a good idea to own the stock, and the other is betting that it's a bad idea to own the stock, right? And most likely, only one of us is going to be correct, because generally speaking, it's good either to own or to not own a stock. Rarely is there a case, I can't think of a case, where it's a good idea to both own and not own a stock, right? That inherently doesn't make sense, right? So with Malkiel's theory, what he's saying is that to consistently time the market or pick stocks, you're not going to be able to do that. Now, underlying that idea of the random walk theory is the efficient market hypothesis. Okay, so the random walk theory is really an extension of EMH, because if you think about it, if the market is maximally efficient, right, all new information is very quickly priced into stocks. So then you really aren't going to be able to beat the market, because it's processing the information as quickly as you are. And so all of that data is being calculated into the price and trading volumes of a stock. And so there's really no way to beat it. So EMH underlies the random walk theory. Okay, so if you are a random walk theorist like Malkiel, so in general, um, you're going to be essentially a passive investor, meaning that you'll invest in index funds, things that look to replicate the performance of the market overall, as opposed to an active investor who's actually trying to pick the winners and losers of among the stocks. Okay, and it makes sense. So if you think of exchange traded funds, which are or index mutual funds, those are the kind of passive investments to which Malkiel is referring. So you don't when you're doing that kind of investing, it doesn't matter. The performance of an individual stock does not matter. A new piece of information coming out doesn't matter, because what you're doing is you're investing overall in the performance of the market as a whole. And so if the market is going up, you're doing well, and if the market is going down, you're not. And that's basically his theory. And then he goes into he goes through evidence that he believes shows that index traded funds outperform so-called managed funds. So and those are basically the two types that you have. In a managed fund, the fund managers are actively picking which securities are going to be a part of that fund. And by the way, they may even pull out of, in essence, pull out of the market and keep a lot of the fund's assets in cash. So if you're in a managed fund and the managers think that the market is peaking, they may sell out a lot of their holdings in anticipation of the market declining so that they can buy back in at the market trough, or as close to the market trough as they can come, right? So managed funds are working to take advantage of changes in prices among individual stocks, et cetera. And Malkiel provides data, evidence to show that if you look at index funds versus managed funds, that the index funds actually outperform the managed funds. So, and the durability of his theory is such that it appears that that's a sound analysis. Now, why doesn't everybody do that then? Well, the reality is that for very sophisticated investors who can put all their time into analyzing the market, so they may be able to take advantage of small opportunities to make higher returns than the market does overall, using techniques like arbitrage and those sorts of things. And so one of the ones that comes to mind is Constellation. This is a fund that has, I think it's actually a series of funds that have consistently outperformed pretty much all the other ones, right? And it's well nigh impossible to become an investor in them. But here's the thing. Because of the nature of them, all they do day in and day out is look for opportunities where they can eke out a slightly higher return or more than a slightly higher return than the market overall, right? That's all they spend their time doing. Now, you and I, are we going to do that? No, we're not. Now, you could say, well, why aren't all the funds doing that? And the answer is that theoretically, managed funds are all trying to do that, but practically, only some people have the skill, the experience, the insight, and this sort of je ne sais quoi, I don't know what to call it, that allows them to sort of sense the market, if you will, and know when to make these different market moves. And so most of us, even if we spent all our time, managing a stock portfolio, we're probably still not going to beat the overall market, which is the underlying um, idea behind Malkiel's theory. Okay, so another thing that Malkiel gets into is behavior finance, which we talked about before, and he talks about these different factors and how they cause randomness or illogic in the markets, and so he talks about that as well. So if you read the book, you will get a nice grounding in that theory as well. But you can see that this idea that people act irrationally, right? If people are acting irrationally or unpredictably, right? So that does support his idea of this random walk, right? Because we can't predict which direction the markets are going to, or individual stocks are going to take, or the markets are going to take, and the ideas behind this, the psychology and economics of behavior finance theory seem to support this idea that randomness, if you will, or at least illogic, is a fundamental factor of the markets, of stock markets. Okay, he also talks about what he talks about some of the other strategies. He talks about technical analysis and fundamental analysis and these different things, and he goes into deeper explanations than I did about these different hypotheses of how, or theories of how one should invest. And again, he presents the case for why random walk is a superior approach to these, by pointing out the difficulties in exercising these theories, and giving you examples of why they don't work over the long term, right? So the random walk theory, I should add, is essentially a long-term investing theory. So if you're looking to make a killing in the market and get out quickly, the random walk theory isn't. There's really no theory for that. That is sort of straight up gambling, right? The way to make money in the stock market is to map out a long-term strategy that fits with your beliefs, your sort of constitution, the amount of risk that you can take, etc., and stick with that. And so that's really what Malkiel is helping you understand, is really, where are you going to find comfort, in the sense of being able to sleep at night, as well as success when you're investing in the stock markets. Okay, and then he wraps up by giving some practical advice for individual investors, looking at low cost strategies, things like no load mutual funds, where you're not paying big management fees for the management of your investment, because in general, because he's not an individual, he's a passive investor theorist. So he's recommending that that you invest in funds, especially index type funds. But different funds come with different costs of management. Okay, and so you need to understand those and see what are those costs of management that you're going to incur versus the performance of the fund. And so he helps you understand how to examine that and make decisions around that. And then he also talks about having a well-balanced, diversified portfolio. That too is a very fundamental aspect of investing in the stock market, any kind of successful investing in the stock market. It's very foolish to put all your eggs in one basket. And by the way, that's true in any kind of investing, whether it's real estate, whether it's precious metals, commodities, whether it's stocks, bonds, etc. Right? If you have all of your money invested in one thing, then if for some reason that one unexpectedly goes awry, so now you've compromised your entire net worth, right? And for those of you who, like me, are fans of Downton Abbey, you probably recall that Lord Grantham, um, uh, pre World War One, invests almost all of his wealth in railroad stocks because everybody is touting them because there's going to be such big growth in railroads because of the war and the need to transport material, et cetera, et cetera, et cetera. And but instead of diversifying his investments across many different railroads, he puts it all in one particular railroad that ends up failing, and he loses all of his money and fears that he's going to lose his estate and everything with it, right? And that highlights the foolishness of not having a diversified portfolio, no matter what it is. Because things, especially with an individual company, it can look perfectly strong on the outside, and you may not realize that the fundamentals of the company are just not there, or maybe there's something nefarious going on in the company that is not public knowledge. The officers are putting their hand in the till, so to speak. So always a bad idea to put all your eggs in one basket. Always a good idea to diversify, your investments, and not just your stock investments, but your investments writ large. So you're well advised to have investments in different sectors, whether it's stocks, whether it's, like I said, real estate, commodities, whatever it is. Even things like art and collectibles or whatever. All of these things should be examined as you make decisions about how you're going to, structure your holdings, your financial holdings, and even for a small investor. Okay, even if you have just few $100s or a few $1,000s to invest. So the idea is to be as diversified as you can within the holdings that you have. And so, while if you only have a few hundred or a few $1,000s, you're probably not going to own real estate and stocks and whatever. But still, rather than owning one stock, you'd be better off owning something like a mutual fund, where that mutual fund owns a broad array of stocks. And even if you own just a teeny portion of it, still you're benefiting from the diversification in that mutual fund or in an exchange traded fund, whichever one you decide to do, or whichever one you get advice to do, and then decide whether to take that advice or not. So these are the principles that you'll learn about in a random walk down Wall Street. I'll show the book one more time. This isn't what the current book looks like. I will put a link to the book in the show notes. It is going to be in an affiliate link. If you were to click on the link and buy the book, I think I might get 3 cents or something like that. So full disclosure. But in any event, like I said, this has been my favorite book on stock market investing, since the early 1980s when I first read it. It's up there with Stephen Fogle's book on real estate that I've recommended in previous shows. If I could only have you read, 2 books on investing, those would be the 2 books. And so, while even though this show is not about real estate, I will put a link to Stephen's book in the show notes anyway, since I mentioned it, and you may want to check it out. Stephen's book is out of print. It was also written in the early 1980s, as I recall. You can find used copies, typically on Amazon, and it is well worth the price of the book. Anyone who has ever talked to me about getting involved in real estate investing, that is the number one book that I recommend. I wish that Stephen would reissue the book, but he's He's an older guy now, older than me, as a matter of fact, and so I suspect he's living a comfortable, pleasant retirement. And so what does he need with the mishigas of reissuing a book? But in any event, you know, this is all food for thought, and that's one of the best parts about a random walk down Wall Street is it gives you food for thought, so that you can make active decisions. You can actively decide what is the best way for you to approach stock investing, and also speak more intelligently with people who may be advising you about what kind of investments to make. So you'll have a better understanding of the concepts that they're talking about. You'll have an understanding of how markets may work. And so as you talk to people and build your knowledge, right, this will give you a foundation from which to work. And that's always the best way, right? That's why we call it a foundation, because we put something solid at the bottom on which we build, so that as we get more and more, we don't undermine ourselves and have it collapse. So that is a random walk down Wall Street. And I'm going to end a little bit early today, but that's okay. No sense dragging things out with a lot of extraneous blather. So if you have any questions, comments, criticisms, by all means, feel free to post to our social media. All the links will be in the show notes, and always interested to hear from you. And you can, if it's something that's more private, my email address will be in the show notes as well. You can always send me an email. Happy to respond. If you're asking for, specific recommendations or such, especially if you're asking for recommendations about investing, I don't do that. So this is not that, I would be happy to refer you to someone who does, if that's what you're looking for. But please don't, if you ask me, well, what do you think about stock such and such? My answer is going to be, that's outside of my, scope of knowledge to advise you on. You need to go to the experts. And as well, while we're talking about show notes and my YouTube channel, if you're not a subscriber, please do consider clicking on that subscribe button, and that way you will always get a notification when a new show is starting, and you won't miss any of the episodes of the Way to Wow shows. So speaking of which, on Monday at 10 a.m. Pacific time, my guest is going to be Paul Rabelais. Paul is a real estate, I'm sorry, not real estate. He's an estate planning and administration lawyer in Louisiana. And he's going to talk about the 6 unique aspects of Louisiana estate planning. Now, you may say, well, I don't live in Louisiana, so I'm not going to watch that. But I encourage you to watch it, because several of the things that Paul talks about are applicable beyond the state of Louisiana. They're important concepts to understand. And also, Paul has a great amount of knowledge about the history behind probate law. And so it's quite fascinating to hear his thoughts on that as well. On Tuesday, at 10 a.m., also Pacific time, is my show, Business Lessons from the Military. And we will be talking. So I'm actually going to be, this is going to be a very special show for me. I'm going to be talking about something that happened to my father when he was in the Navy back in the 1950s, lessons that he learned, that he taught to me as a boy. And sort of in recognition of the upcoming Independence Day holiday, do a little tribute to my dad. And this is a story that's near and dear to my heart. I used to. I've told this story when I've given talks to different groups, including I gave a talk to the Army unit in Okinawa when I was first stationed there, and they really enjoyed the story. So join me Tuesday at 10 a.m. And then on Wednesday at 10 a.m. is my show, is the next edition of People Making Money, where we will continue to talk about building wealth and improving our business and professional lives. So I thank you very much for watching. And I wish you a wonderful rest of the day, as well as a wonderful rest of the week. It's a little bit of a tongue twister. And signing off as I always do, Marie, darling, you are my bell. Courage at all times, my friends.